Welcome to the Dividend Talk podcast, episode 141. Stocks we don't feel comfortable about going into a potential recession. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. So sit back, relax, and join us as we dive into the world of dividend investing and discover the power of passive income. Good morning, European DGI. How have you been this week?
Hey, good morning. Actually, I've been really good. A bit busy at work, of course. It's this time of the year, March, April. So again, people have seen me a little bit less online as well, sharing things about investing. But that's also the great thing about the sleep well at night portfolio, right?
Yeah. Hey, what I am looking forward to, it is coming up to spring. And I always look forward to your annual spring cleaning kind of report. I think you normally do a blog post or a video or something. So that should be soon,
Correct.
right? Yeah.
Yeah, I usually do it in the first week of May or something like that. That's in Poland when you really have the feeling of spring. That's usually then when I do my annual portfolio cleanup. Often it leads into selling some small ancillary positions and redeploy the cash to the more where I have more conviction there. And what I like about the spring cleaning is, for me, it's that you're not selling it when it's already crashed. Yeah, you're just reevaluating some of the businesses, check whether you like them. And actually, we have a bit of this topic of this today here as well. So, and then it's more like opportunistic, I would say, under calm times usually.
Yeah. It's a good topic today based on that. It might give you a little bit of your prep work just a little bit in advance. But before we go into talking about stocks in our portfolio, is there anything in the news this week that stands out?
Yes, definitely. What stood out for me, first of all, was the news about Novo Nordisk being the second biggest company in Europe by market cap. Amazing, right? And if you've seen the run-up of the stock price over the last few years, I mean, talking about compounding, right? Of course, also the valuation is really hot, I would say. But this new drug, this obesity drug, Wegovy, and Ozempic are really doing well. And I actually also read an article about it, that whole Hollywood is almost on this drug, because when they need to do a movie or something like that, or when they want to lose weight they lost, then they typically seem to take these kinds of Novo Nordisk drugs, because it's kind of a way of cheating yourself into quick loss weight, right? So, and there are even supply issues in some of those areas there around Hollywood, from what I read. But credits to Novo Nordisk, they are doing really well, and they kicked off Nestle now. Nestle from the second place, and if you think about how much turnover Nestle has in products worldwide, their water business, then yeah, it tells you how much drugs also Novo Nordisk is selling at a nice margin. Amazing.
Yeah, it's crazy. But like, if you go back to that story just a little bit, it's a diabetes drug, I think, by default. That's what the drug is for, and it's been used by individuals as an appetite suppressant. I mean, that just blows my mind. It's not being used what it's designed for. But look, all credit to Novo Nordisk. We know it's a quality company, and it's one we spoke about here before. I regret not initiating a position in them closer around COVID, but to knock off Nestle is a massive brand, so it's quite an achievement, I think.
Yeah, and of course, it's market cap, right? So there's a lot of future priced into that, but it still has one to go, and that's Louis Vuitton. So let's see if it can get this one from the first place. But why not? Why not? Yeah.
Yeah. Why not? If Hollywood is taking these drugs, it's definitely going to spread out more. So you never know.
Yeah.
You never know.
And if you think about it, we had Dividend Day once here, and also you wrote an article once on my blog about Novo Nordisk and the Novozymes, the whole franchise that they have. It's quite amazing for such a small country like Denmark to already produce effectively the second biggest so far by market cap company in Europe.
Yeah,
Really
yeah,
amazing.
it's pretty good. So what I seen this week, we heard of inflation, right? But have you heard of shrinkflation? It's it's a
Tell me
phenom
more. Tell me
it's a
more.
it's a phenomenon that's happening. Unilever, for example, has cut its Magnum packs by a quarter, but the prices stay the same. So they had this pack of four, I think the pack of four 100 milliliter Magnums, and now they've cut that to a pack of three, but you still pay the same price as what you were paying before. I mean, I don't know how they think they can get away with this. If you're a family of four, who I would imagine
Which is
who's
kind of
buying,
the average.
yeah,
Yeah.
which I would imagine is buying these family packs. That's what they are. You're going to have one kid that's not going to be happy. They're
So
going to
you
be
buy a
left out.
second box.
You have to buy a second box, but it's quite interesting to see it, isn't it? Like that. That just shows you the pressure they are under cost wise, and I know that they will expect sales to decline from this, but they obviously have it worked out in such a way that they think that sales will decline less than what it costs them to produce
Yeah.
the three pack.
Yeah, and they have to test with it as well. But look, if you're now a family of four, you would need to buy three of those packs, right, to have two ice creams out of it. So I wouldn't be surprised if we see record Magnum sales or ice cream sales at Unilever this summer being reported. And what is funny, I also looked at the sizes because I've felt that the sizes are shrinking when you go to the shop.
Yeah,
So I checked. The original Magnum ice cream was invented in the 80s, 88, I believe, and then really pushed globally more in the 90s. That's from when I remember it. And at that time, it was 120 grams,
yeah,
120 milliliter and 88 grams or something like that. Well, I was a kid, so maybe that's why they felt so big because my mouth was still small. But they last year, they also cut it in July 2022 from 110 to 100 milliliters. So it already reduced also over the years like that. But then even that's for the Magnum Classic. Also, other Magnums that have been released have been just sometimes being released for less than 100 milliliters. So overall, the experience from us from the 90s is that they are becoming a regular ice cream, because in the past it was like you had normal ice creams, and then
yeah,
you had a Magnum, and you knew you had like an XXL kind of ice cream.
yeah.
So they're taking this kind of experience away. It became like a regular size. It's still only the crunchy of the chocolate and the vanilla inside. And now they give you also less in a box. So yeah.
Yeah, but it definitely does show the pressure, and you're thinking that the show's about going into a recession, and if we do go into a recession, you imagine premium brands like Magnums will will disappear from a family shopping list, and they will maybe go with the Aldi or Lidl or some other value version of it. And then on top of that, they've now reduced the size quantity of the box, so you can see that there'll be a lot of pressure on these. But it's also an interesting fact that chocolate and ice creams are the most complained about shrinkflation products ever. So roughly 25% of customers complain about chocolate in a negative light. It always just seems to get smaller and smaller and smaller.
Yeah, and we continue to be more and more upset and emotional about all what's going on in the world. So we actually need more chocolate. And then
Exactly.
having the price on top of that, no wonder that half the world is in a depression right now.
Yeah, exactly. Yeah, it's all Unilever's fault. We need more chocolate, guys. Dividend hikes this week. I don't think there's been too many that I've seen.
No, not at all. I mean, some companies that we are not really interested in. I just wanted to call out maybe the German utility RWE. They announced a dividend of €1 per share for the upcoming year, which is 11% more than the year before. And if you then look at the other European company, they actually cut their dividend almost in half, and that was from coffee machine maker DeLonghi, Italian one. That's a company I've been often looking at. I've got the DeLonghi machine at home. I studied them. It was never convincing me enough to do a further, deeper research. But I love the brand because their coffee machines are really awesome. So yeah, they cut the dividends. So I will never own some shares probably in that one.
Yeah, I'm not sure with DeLonghi, are they targeting retail coffee, or do they also target like your baristas with the machines?
I believe it's both. It's both, but they are really big in the retail. If you go into any shop, electronic shop here, you see them in the queue lined up. Premium brand. Yeah, they have a lot of shelf
Yeah.
exposure, let's say like that.
So that just makes me wonder: is it people are buying cheaper brands, or are people going out and buying coffee more? One has a better impact on, say, the likes of Costa and Starbucks, and then one maybe they're buying cheaper machines for home.
Yeah.
But I don't know. I haven't studied the company, but
Mm,
it's an interesting concept to see the reason why they've had to
yeah.
cut.
Yeah.
Awesome. So let's talk about our portfolios. Look, the markets are a little bit crazy at the moment. We struggle to find some news of the week because it is overbearingly about banks, as you will expect at the moment. It's pretty much been shoved in our faces everywhere we run online. But there is concerns that this could lead to a potential recession. And I think it's always good to look at your portfolio and see what kind of stocks would you not feel comfortable about in a recession. So I might go first, okay? And the first one on my list is HPQ, okay? And I'll tell you what, my whole investment thesis around these is around our really, really strong free cash flow generation. I mean, we've looked over the last couple of years, and it's always been incredibly strong. Even when demand was weakening for our products, they've always generated a lot of free cash flow, and our capital allocation was around giving the shareholders as much money as they can in buybacks, but also in dividends, but also buying back shares because they're at a historically cheap price. That was my investment thesis. They generate strong cash flow. I was not expecting huge growth out of these guys. They're in a really competitive market, so it's hard for them to see exponential growth. But as long as they were generating consistent cash flows and committed to paying out that dividend, I'm happy. We fast forward to Q1 2023. We can see that cash flow got hit massively, almost to the point where it's negative compared to 2022. I kind of ignore 2021 because that was an outlier year based on demand. The consumer market is pretty weak at the moment. We're seeing it across all HPQ, Dell, Lenovo. It is extremely weak. Going into a recession, that will only get weaker. I think HP have a strong enough balance sheet now to withstand that for a short period, but it just depends on how long a recession is, isn't it? If we have a prolonged recession, that's when their balance sheet will start getting weaker. They've already culled their cutbacks. They've done, I think, only 100 million in share buybacks in Q1. They're doing zero next quarter. They're not doing any compared to 1 billion this time last year. So you can see they've scaled that back. So that's my main concern here, that cash flow is going to take a massive hit. If we have a prolonged recession, we could see that dividend being hit as well. That's my main reason for adding these onto my watch list.
And maybe out of curiosity, do you think their dividend is safe?
I do believe that dividend is safe at the moment. As I said, it's more depending on how long that recession would last for. If we saw a recession lasting for like 12 months and these continually have negative cash flows each and every quarter, how are they going to pay for that dividend? The only way they can do that is by raising new debt. And in the current market, you don't really want to do that either.
Yeah. So they pay about 260 million in dividends per quarter.
Yeah.
And if you look at their free cash flow, yes, over the last quarter, it was slightly negative, 200 million. But if you look over the years, I think it should easily be able to cover the dividends.
Of course. If we're looking at past history, but I'm saying if we take this quarter and it's not in isolation and it continues in that trend, then they won't be able to cover it. But historically, they've been fine.
Yeah. But would you then, because let's assume a weaker consumer, how is it, trend. Also, the reason why they had lower free cash flow in the last few quarters is because of sales being brought forward during COVID when everyone suddenly needed a laptop.
Yeah.
So, and we saw many of the chip makers struggling with this, with a general slowdown as well.
Yeah.
So let's assume that the consumer continues to be weak. Do you see yourself selling it then?
I would be selling depending on their cash flows and how well that dividend is covered. If I feel the dividend is not covered and the prospects is not turning anytime soon. So if we have a full year of negative free cash flow,
Yeah.
free cash flow growth, and then the consensus or the growth prospects are still a weakened market, I would
Yeah.
probably end up selling at that point.
Yeah. Okay. So that means that you don't have generally a strong conviction about the business when you bought it, because what I'm saying, for me, a player like HPQ is more like a cyclical company.
Yeah, of
So
course.
I expect them from time to time to, well, not necessarily to straight away make a loss, but under like economic stress to not sell a lot. Yeah. And therefore the question is more like, can they have like 2-3 years trouble, but still commitment to the dividend? And should the company after that still be healthy? And for me, HPQ makes the cut, although I believe that what we have seen over the last four years, let's say, their aggressive buyback, also a lot via debt, in my opinion, was actually quite smart. If you looked at the multiples at the time, I think they have been doing a textbook example of smart buybacks at the time.
Yeah. Yeah, and I get that, but again, my investment thesis was around their strong cash flow generation and their ability to pay that back to me in dividends. I've been guilty in the past of holding on to a company because I like them and so on, but I just want to focus on the numbers and the possibility of that dividend cut. Even if they don't, I would rather be invested in a company like Johnson & Johnson, where I'm 100% sure they're not going to cut the dividend, that their free cash flow covers their dividend, rather than someone that's struggling over maybe a year, 2 years, and the option of the dividend cut is more likely for them.
Yeah. So one more challenge then.
Go
Why
for
not?
it.
Why not sell now while the share price is still relatively holding up? Because you might otherwise end up selling it at I don't know, $20 instead of $28 right now. Because Johnson & Johnson is yielding at 3%. We expect a dividend hike in April.
Yeah. So that's a good question. That's a fair question. I'm not selling them now because I don't believe in this moment in time that the dividend is unsafe. I think that it's 1 quarter that they've had it. As I said, I need to see, I need to monitor this over a full year and see what the trends is over. I am expecting the second quarter to be just as hard as this one. They've already said that, but according to their own analysts and according to their guidance, the second half of the year is when they'll start ramping back up and they should generate enough to cover that dividend. But it's probably going to be the third quarter of this year when we'll see whether the market goes as they expect, or are they keeping that?
Okay. Good. Yeah. So HPQ, how you said, it's not my strongest conviction in my whole portfolio, so I'm with you there. But I also bought them consciously, being a cash machine in the end, where I believe the market will always look at it as a printer salesman, let's say, printer reseller, which I believe is incorrect. I see the world needing more and more computers, laptops, powerful as well, and I think there are not so many players that build this for at scale for the masses, and I think HP has a unique position there. So over time, I think it will do well, but I also look at it, as I mentioned, as an industrial, more like a cyclical company that has its ups and downs. And then the question is, how does it deal with their cash generation over time? And I think that's what they have been doing well. But it is supposed to be a small position in my portfolio.
Yeah.
So for me, the one leading into a recession that I feel, let's say, a little bit uncomfortable with, or and such, and the biggest one I would say is Omega Healthcare investors. And Omega Healthcare investors, why? It is 5% of my dividend income that depends on them. So from one side, you could say it shows my diversity in my portfolio, that many companies don't go much further than this level, and that's how it's been designed. It's not a target dividend income share. I wish it to be more like 2%, but the other areas of my portfolio would need to still grow over time. Yes, so for me, it's already a full position. Look, if you think about Omega Healthcare investors, they are really targeting what I call like the last mile people, like dying the last few days, that's where they offer their services
Yeah.
and their rental space. They have around 65 operators, 900 properties, both in the US and the UK. And they even report the amount of beds. They have 89,965 beds. So I hope that not one of the beds broke. But what is the tricky thing here? It pays nearly a 10% dividend at the moment, and they have an investment grade of BBB minus. BBB minus is literally one level above the non-investment grade. Now we see this more often with real estate investment trusts, so that's in itself not a red flag, but it's the combination, because before COVID-19, they were already struggling with hiking their dividend. But then when COVID-19 hit the company, it really got bad. Many tenants struggling, some went bankrupt, continuously restructuring. I do believe that if there's one real estate investment trust that has experience in restructuring their clients, it's them. Yeah, they are really top notch nowadays in this, by all the experience they gained, and they have been actually doing it miraculously well, I must say. So the good thing is, in their contracts, when the tenant cannot pay off, most often Omega Healthcare gets the chance to, let's say, restructure it. But then COVID-19 came, and many of the people died already in the hospital before even entering such one of their nursing facilities. And 10% approximately of their operators at this moment, according to the last quarter filing, could not meet the mortgage payments. Yeah, so that's a lot. That's really a lot. Now, again, surprisingly, their FFO, funds from operations, that we use as a measure here as cash flow, has been doing, how is it, relatively well, but still the dividend was not covered. But if you go to the adjusted free funds from operations, it was covering it. But we don't like the term adjustment here because it makes management always look better. So for me, I have a feeling here like what Shell had at the time. Shell came out of an oil crisis in 2016, hit their earnings power really severely. It was just crawling back up in 2020, and then COVID came, and that was for them the nail in the coffin for their dividend streak record. And I have the feeling here as well with Omega Healthcare's. I think the company is really committed to the dividend because that's what they know their investment cases is. But if now something would happen again that really puts, for instance, government funding for those support programs at risk, I think that would be the nail in the coffin. They are doing kind of managing it well in really difficult setting, but they need a breather, yeah, and they still need 2-3 years probably to get out of this. So any deep crisis that cuts into government funding as such, for instance, if they need to bail out many companies, therefore there will be not a lot of federal budget left for those kind of healthcare programs, yeah, which they in the end depend on. I think that will be really putting the dividend at risk. So that's where I don't feel really comfortable. And now the issue, of course, with this company is like what to do with this, right?
Would you see them diluting their shares quite heavily to sustain that dividend?
I think that's a typical option for a real estate investment trust to raise capital like that. I think all options are typically on the table. Not today, but we're talking about what if there's stress, right?
Yeah. And what's your yield on cost?
I think if you look at it from that point of view, my yield on cost is probably 9% or something like that. Let me quickly check. My yield on cost is 9.9%, and currently the yield is around 10%. So I'm kind of flat, although over the years I have earned half of it back in dividends from my investments. So I have a 50% return over those years. I did have a bigger position in the beginning. I trimmed it a little bit to be in sync with my tier system.
Yeah.
But of course the dividend yield is really high. So if I would sell this position, there's no position where I will get the same yield for a company that I know as well as Omega Healthcare investors here. And I always had it for the high yield, expecting no dividend growth or really low. But on the other end, before I bought, was before COVID and such, and before the mess happened, I did believe that their dividend was safe.
Okay.
I ranked their dividend as borderline safe at the moment, which means, yeah, I wouldn't be surprised if a dividend would be cut. I don't think they would cut 10%. They might cut it to 5% in half. But then the question still is like, where do you see opportunities that give you the same dividend yield with then again an opportunity to grow? I think it would do a lot to my capital that I have invested, my principal. So this for me is really a difficult one because the opportunity cost in dividend income, that's where really the difficulty here is. I don't see this company going bust as such.
Yeah, and
People will continue to die.
Are they an automatic sell? If they cut the dividend, is it an automatic sell, or does it depend on
No.
the level of the dividend cut?
Yes, because I've classified this as a high yield company, not so much as a dividend growth company. And I've got two other companies like this. That's BHP Billiton, the mining, and Rio Tinto, the mining. I know that they cut their dividends from time to time, but over the years they give me high yield. So this also means that from, let's say, my total dividend income, I've got, let's say, 10% of my dividends that I have dividend income that I haven't classified as dividend growers, but more like high yield, which means that 10% is automatically at risk during crises. And I'm really sensitive to that because I always say, I hate it when a company cuts their dividend when I need it the most. So that's also when you think about financial independence, retire early, I will not go at 100% coverage. I will go at 110, 120% coverage.
Okay, good. Nice one. I move on to one of my second companies, and that is BASF, the German chemical maker. We do know that chemical production in Europe, particularly in Europe, is starting to slow down at the moment. And the company are responding to this by investing heavily in CapEx to support future growth. And they're doing this pretty much outside of Europe. I think China is their main target audience there. But if you look at their projected plans, right, their CapEx is, they've put aside 28.8 billion over the next 5 years, up until 2027, over the next 4 years, with 2024 and 2025 being the peak years of this spend. That equates to roughly about 6.3 billion each and every year. It's not going to be exactly that, but that's if you were to average it out, okay? When I look at their dividend equates for about 3 billion at the moment. Their free cash flow was 3.3 billion, which gave them quite a high percentage payout ratio as it was. And now we're adding in this additional CapEx on top of that, which is going to put huge pressure on the free cash flow. BASF have cut the dividend in the past, and I don't see a scenario where they're increasing their CapEx to a point above their free cash flow where they can't cover their dividend and sustain that dividend. I could see them generally cutting that dividend right next year or 2025, and then as future growth happens, they might take off. But for me, that's my main thesis here is like, it's a declining European market. CapEx is growing, free cash flow is steady. They've actually forecasted that to decline again next year by about 10% on top of this CapEx. So I would not be surprised if this company did sell or did cut their dividend. And as such, I'm contemplating selling them for that reason.
Oh, that's really, really interesting because I think you own them also as part of the dividend harvesting. How's it called?
Dividend.
Dividend capture.
Oh, dividend cap.
Isn't it?
Yeah. So that's how I ended up with these guys. I was doing dividend capture and option trading, and they ended up in my portfolio. I actually looked at them at the time. I think that was roughly 18 months ago, and I was like, okay, the dividend looked relatively safe. But the picture is starting to change, particularly like that is a cyclical market, I suppose, similar to HPQ. These guys are cyclical, and it's how they deal with that in that moment in time. But I just believe with the CapEx spending to grow aggressively over the next 2 years and free cash flow to decline, I think it
Yeah.
does put massive pressure on their dividend in an already cyclical company.
Yeah. Well, honestly, I'm so much more optimistic than you because they have a really strong dividend growth history since the early 2000s. And
Yeah,
only in 2008 and 2009, let's say, they cut the dividend by 10%,
yeah.
just 10%. And they have been growing since then again. They've been always very articulate about their dividend policy to have a flat or growing
Yeah,
dividend, and they have a pretty decent balance sheet, right? From
uh,
that point of view.
of course. Um,
So yeah, I can see when you look at the cash flow and their investment needs, I fully can follow your story, but I'm a bit more optimistic towards the commitment of the board of directors towards the dividend.
yeah, and the balance sheet is one of the reasons I ended up staying with them when I did that dividend capture.
Mhm.
They do have a pretty strong balance sheet, but if like, I mean, if you have 3 to 4 year plan like they have of extreme
Yeah,
capex spending,
yeah,
there is a risk that could get worse and worse for them to pay it. It actually might make no sense for them to, to continue rising or
yeah,
holding that dividend. It might make sense to cut it, keep the balance sheet strong, and then once they
yeah,
come out of that and are generating strong, increase
yeah,
again. It would make more business sense, and I would be happy for them to do that. But
yeah,
again, this is a low grower. I think this year they cut it steady. The 5 year dividend growth is like 1-2%.
yeah.
You don't get a lot of growth from these guys, so you're pretty much in this for yield, not growth.
Exactly. Yeah,
And if
that's true.
there's a risk of them cutting that dividend, then that yield perspective is gone. You
Yeah.
also have no growth, and I don't see a case then where they sit in my portfolio.
Okay. Fair enough. But I think yeah, I think we disagree on this one, but
Of course,
that's what makes investing so nice.
yeah.
I'm good in having yield suckers in my portfolio. So kudos to you. Good, good, good. So look, let's stay a little bit in the industrial space because the second company in my portfolio that I don't feel comfortable with going into recession is actually really a tricky one for me, and that's 3M. And sometimes we get questions about whether I'm buying more. So, full disclosure, I'm not buying more at all, although it looks very attractive sometimes, right? So, just look at the positive part of this story. They pay 5.98 cents per share or something like that per dividend. They have 64 or 65 years of consecutive annual increases and have paid a dividend for more than 100 years without interruption. Now, that's already just like iconic. Then if you look at their valuation right now, less than 10 price to earnings, 14.5 price to free cash flow. They have a payout ratio of 58% and a yield of about 6% at the moment. Also, a return on invested capital around 18% and a return on equity of 40%, but that number I wouldn't look too much to. A debt to equity of 68% as well. So this looks all really good. Yeah, it's not a fast grower. From these numbers, you can see a slow grower with a decent balance sheet, with a really attractive valuation based on the headline numbers. But then we get there to litigation cases, and you and I were both talking about this already. Like in their latest, so they had like I believe it was on Thursday. They had a Barclays investor update or something like that, investor presentation, and what they said like they can't predict what the numbers going to look like for the litigation and the settlements, and therefore the guidance that they have given of around $8.5 to $9 exclude those litigation matters. So if you purely would look like that, taking the litigation out of it, you would talk about a forward PE of 12 or something like that. But this litigation is just on top of this. And this is what makes me so concerned because I don't trust American jury systems. We have seen it with Bayer, with the Roundup cases. For me, it's still astonishing that the Department of Defense did a whole, I would say, tender, selected the right earplugs. And then later there's this issue with it. But all the blame is put on 3M. So I'm of course a bit biased maybe here because I'm an investor, and I truly hope that people that really have suffered from this get their support and whatever they need. But it's so much different in Europe than in America with these kinds of things, right? And so for me, this is like a sword of Damocles hanging over 3M here. I mean, if we're talking about 10 billion, okay, great. Let's take it on the chin, put it on the balance sheet, and we'll move on. But with this one, I really don't feel comfortable. And if you then also take into consideration that industrial, that during cycles, also the numbers look much worse. I mean, it will be tough for this company to ever cut the dividend, really tough. But if you ask me, what do I feel comfortable with going into a recession? It's really, really this company I'm comfortable with. Yeah.
3M are a bit of a mind messing, they kind of mess with your mind a little bit, because on the face of it, you just look at the numbers in isolation, they make perfect sense. But then it's as you said, it's that litigation. Even management came out and said, look, they've guided numbers for 2023. However, this excludes any litigation cost because they cannot put an estimate on it. And that's a little bit scary. They have zero idea how much this is going to cost them, which means we have even less of an idea how much this is going to cost them. And as you said, they're coming to kind of like the end of their cycle. We can even start to see sales declining, margins are declining as well. So it's coming at a bad time in general. Anyway, not that litigation can come at a good time, but it's converging with the end of a cycle, and it put these guys at risk. I feel like their dividend could be safe if it just depends on the amount of the litigation, but management here will not want to cut that. I mean, they've got a 60-odd year history of paying dividends. They won't let that go too lightly, but at what cost? That's the key question. It's a risk. It's a huge risk, and for me, look, I think even if the litigation gets sorted out in some news, they're not going to double in price overnight. There'll be a 10-20% increase, but even at that, they'll still be actually fairly decent value. So I think there's plenty of opportunity to get into 3M once we get a little bit more better news story from them.
Yeah, even if in such a day that everything is settled and it hits the news and say price, let's say, goes up 20% on a day, yeah, you're still not missing out. You shouldn't be price anchored. Then now they're like $100, but if you can get this company for $120 with such good news behind it, it's a steal. Yeah, yes. So to say.
Of course. Yeah. So for me, this would be a risk reward. If you're going to make that play, you have to be 100% sure of the risks here. And for me, that's too high.
Yeah, but I've already Bayer for 5 years of experience with this one. Yeah, and it went nowhere in those 5 years. So to your point, we get, as long as this litigation is not clear, like with Bayer, we still, all this time we get opportunities to buy more, because it will always overhang over the company. So for me, 3M, I really don't know what to do with this one. There are days that I'm thinking like, let's snoop few up. There are days that I think like, let's throw it out of my portfolio. I don't need another one like Bayer.
Yeah, it's an issue, but I agree fully. We agree on one at least, but I agree fully on 3M. It's in the too risky bracket for me until we get some more news. It's a shame.
But here it's really the yield trap, right? The yield is so attractive. If you look at the past history, it's so attractive. I mean, it makes my heart beat quicker, right? But then the shit on top of it.
So my fear is like, particularly new investors, and I think we've all done it. Okay, so you get the dividend aristocrat list from Drip.org, right? You look at it, aristocrats. You see 3M, 60-odd years of dividend increases. Check. Dividend yield 6%. Oh boy, I'm definitely and they invest in them for that reason and only that reason. And that's what's scary. They might look at one or two of the metrics that you mentioned. Tick, tick, tick. Boy, that's the problem.
And you might also start reasoning like this. How bad can it be? Yeah, earplugs, the PFAS and such. They had great management. They will do well. But what you're really doing is just justifying your decision to buy it at this yield. Yeah.
Yes, it's a tough one. I get it. I struggle. Like when I see it, I think it dipped under 100 marginally. You're kind of tempted. You're going to go, oh
Yeah.
boy.
Buy, buy,
But
buy, buy, buy. Yeah.
but I've held that temptation off. Okay, we'll go on to the last company on my list. And do you know what? It was quite hard looking at my portfolio. I'm actually quite comfortable with most of them, but one of them, Danone, I'm on the fence about. It's not clear cut for me. As a company, I mean, they have all the attributes. They have huge brand power, particularly in Europe. They have positioned themselves very well in the healthy eating space, and I think they've done that incredibly well. They have some really good brands there, but that is a rising competitive market. INGR are another company that has positioned themselves very well in that market. And for me, I think that market depends a lot on disposable income and also the awareness of healthy eating. Going into a recession, that's where I feel like, okay, disposable income comes under pressure. Now, it depends on how global this recession is as well. If that happens, say, just in Europe and not in America, we could be okay. If it happens in the US and Europe, we're in trouble. And then if it touches China, then someone like Danone is under some serious pressure here, because you have all their geographical areas under pressure from disposable income. And I do believe that in a recession, people move from healthy eating to, I'll put anything on the table so my kids and my family can be fed. We can already start to see that their sales are declining. Not by alarming amounts, but they are declining. They are offsetting this at the moment with price increases. They are also getting rid of, I think the term that they use is focusing on what we know. What that basically means is they're cutting anything out of their portfolio that is not performing well. And we're seeing that they're cutting, I think, nearly 50% of their brands, which I think is good. So they are in the middle of a turnaround. Danone for me is a better turnaround play than, say, Intel, but I still think it's a turnaround.
Yeah.
They've changed their CEO. I'm not quite sure how committed he is to that dividend yet. That's my one worry.
Yeah.
I don't know how committed he will be to that. It looks like he's come in. He's starting to do a good job under tough conditions. He's probably come in at the worst time. But he's trying to ramp it up, as I say, cleaning out that portfolio. But if there was no growth for the last decade, if there's no growth in the next decade, is that dividend safe? And that's my concern. They're not an automatic sell for me here, but it's just one that I'm not completely confident. My conviction is not there for that company like it was 2 or 3 years ago, and that's my concern.
But even if you say if is the dividend safe, let's assume that the dividend is safe, that they won't cut. Yeah.
Yeah.
If the business is going nowhere over the next decade, then the yield is really not attractive enough. Then you want to have a high yield like Omega Healthcare for 8-9% so that you get your return.
Yeah.
Yeah. If there's no growth, but you want dividend growth as well at the same time. And in that case, according to your narrative, I would say like there are better stocks out there that offer a same yield with more dividends, let's say with more prospect.
I agree, because part of the reason they're in this is if I look at their 10 and 5-year growth, dividend growth,
Yeah.
you're looking at 3% CAGR at 10-year, 1% at 5-year. That does not sit in my investment thesis. I want
Exactly.
an 8 to 10% return.
Yeah.
I'm not getting that. I'm putting all my eggs on the potential growth of this company. I think it's positioned itself very well, but how well can they execute that in this current environment? And that's my issue. So I'm on the fence with these, and it's close to a sell for me, because as you said, there's definitely better opportunities out there for me.
Yeah. I mean, I really like their products, and I use them a lot. For instance, the Alpro brand is really good.
Yeah.
And however, I see now a lot of other brands kicking in, and Alpro, they raised their prices in our area around 20% since last year. But their competitors are almost now at a price level of 50 or 60%. So even I start to think sometimes like, should I really buy this stuff at this price when I get the other product, which is not that much different for almost half the price? So I'm also curious to understand like how this price increase is affecting their sales going forward. Yeah, for me, sometimes I feel like maybe I give Danone too much benefit of the doubt here, while it's kind of trying to reinvent itself. I really have a strong believe in the new CEO. I studied a little bit his past performance, and he did really well at the former company. I like all the actions he's taking into account. But like what we just discussed, like, there are other opportunities out there, and how long do I want my money to underperform with them, both from a dividend and total return point of view?
Yeah, it's a tough one. It's funny. I honestly thought you'd disagree with me more on this than Basef.
Yeah, no, it's more like, you live and you learn, right?
Yeah.
And I tell you, the moment I sell Bayer and Danone in my portfolio is the day, or like 2 weeks later, they will be increasing 10-15% here, yields going. I said dividends being increased, and all the shit litigations from Bayer's finished. That's how it will happen, and that's why I'm not selling probably.
I'll be honest. I'm not too concerned about Danone's share price. I mean, we're not share price investors, and I know you mentioned total return, but that's a long-term objective. And
Yeah,
if the growth is there, I've no issue with share price.
Yeah.
But for me, it's that dividend growth on top of that low yield. Like, you're looking at a 3.5% dividend yield. If I'm only getting 1% growth, I mean, come on, I can get better than that by investing in realty income on its own without any
Yeah.
dividend growth. So
yeah.
makes
Yeah, but this is what I'm saying. Like, Bayer will probably then report that they have settled with the US around Roundup.
and double their
Yeah,
dividend.
yeah, and then that as a reward to shareholders, they now feel confident to grow their dividends really aggressively. And Danone will probably have record sales announced the moment I sell. So
Cool. So they have 5 companies in our portfolio that we don't feel comfortable in. I'd love to actually hear from all our listeners what companies they have that they feel could be under pressure, because some of them companies might be in our portfolios and we might learn something. So
yeah, definitely.
drop us comments on all our platforms and let us know what companies are in your portfolio that may not be comfortable holding during a recession. Let's move on to before that, portfolio review. Let's move on to a portfolio review. We got one from a guy via Twitter. I mean, he's 20 years of age. He's an undergraduate in Germany and has been investing a few weeks after his 18th birthday in March. And I'm just going to go through. Look, he has a graph here of the position sizes, and it looks pretty well diversified. But I'll give you some of his holdings. Okay, his top 5: Louis Vuitton is in position 1, Apple is in position 2, AbbVie 3, Microsoft 4, Siemens 5, and I have to go to 6, which is ASML. I have a feeling I know what you're going to say, but give me your thoughts.
I'll give this kid a crown. He's already a dividend king. I mean, I'm not going to judge at what level he has bought them, because it's irrelevant from that point of view. So he might have bought them at overvalued prices, according to us. But if you think about it being 20 years old, none of these companies I can see cutting their dividend in the next decade. Actually, I can see above average dividend growth here, except maybe for Siemens and AbbVie. But all the others, I see them hiking their dividends much more than the industry itself. So I think he's set up for lots of dividends. Like, I'm amazed about the strength of this portfolio in the top here. I mean, he owns some monster beverage. I know it's a growth darling, so it's more from a growth point of view. But if you look at this in general, I think it's a top-notch, top 5, top 6, top 7 portfolio. I mean, I really can't criticize it.
I honestly cannot see one company, and maybe Procter & Gamble is the only one I might not have in this type of portfolio.
Yeah.
But even at that, it's still a top quality. I can't think of too many names there that I would not like to own. The only one I don't know is Sartorius. I think they're a German company, but I'm not sure what they do. But like you said, it's just filled with quality. Yeah, I'm jealous a little bit, particularly how young they're starting. But I mean, we say focus on quality, and I think this is what this guy is doing with this portfolio. I think it's a really good portfolio. I think it's one that will set him up nicely over the next 10, 15 years. At the moment, he's buying Sartorius, United Health, and Canadian National Railway on a monthly basis. I do like the other two, as I said. I don't know Sartorius, but I think it's a smart guy. I wish
Yeah.
I had half your brains when I was 18 and 20. I have to say, but no, well done. That's it's pretty good portfolio, and I can't criticize it a whole lot.
Yeah. He will be retired before he knows it.
He'd be retired before me at this rate.
Good.
Okay, listeners' questions. Are you guys buying insurers like ASR, NN, and Legal and General? Great starting yield and growing.
The short answer is yes. I just don't have any money left this month anymore to buy. But yeah, small surprise. I had Legal and General already for a few months as long outstanding order at 220, and it got triggered this week.
Nice.
So I'm a fresh new owner of Legal and General, but I believe I own enough insurance now. I own all three of them, and it's becoming really large in my portfolio due to the opportunities right now. So maybe I need to scale down a little bit on insurers to stay diversified.
You did give a warning last week in our podcast. If people want to listen to that, as you said, they're not directly in the blast zone, but some of these will hold bonds and so on in their portfolio. So
yeah,
just look beyond the yield and the growth,
exactly.
just to make sure you're comfortable in these markets. I think we're in for some turbulent times. I honestly do, and we could be getting these at better yields, which is incredible because they're already quite good.
Yeah.
Everyday normal investor, are you buying 3M under 100? Look, I think we've already explained our position on 3M.
Yeah, exactly.
As tempting as it is, I'm staying away until litigation is finished. Mike, what do you think about REITs? How do you like Realty Income and Vici at current valuations and yields?
So I know we're Europeans, but you cannot call him Mike. It's Maciej Marchevich. Okay. Good.
I'm Irish, right? These names are too hard for me. Like, just pick easy ones like Sean.
That's true. Like really simple. I like real estate investment trusts generally as an investment holding. About Realty Income, I believe the share price is just going down because of the interest rates, the environment that we are in. I still think that not everything is priced in. So I believe the real estate investment trust could still go down. I still think the market is relatively bullish. But if you think it about as a bond, like Realty Income, you get it now. What is the 5% yield or 6% yield? Then I can see the dividend still growing for years. They're proactively managing the portfolio. I believe they did an acquisition again this week, if I saw it somewhere in the news. So in my opinion, they're good. I know you like Vici more. I don't follow the company, but from Realty Income, I'm not buying right now, but it's always on my radar for if I have some money left and don't know what to put it in, I could always do it in them.
But the only word of caution I would give you is not all REITs are created equal. They'll be in different markets, different sectors. You've got medical REITs, you've got data centers, all different types, and some might do better in this environment than others. So just be wary, just understand what you own, why you own it. Particularly, as we said, rising interest rates, we can start to see rents maybe being under pressure. I think Realty Income, they're triple net lease, and they've built into their contracts that there's growth there, so there is some protection. But just do some research. I like both of them companies. The yields are attractive. They are tempting, but like what European DJI said, I feel like we're going to see a lot more pressure on that REIT sector, and we might be able to pick up some bargains along the way. Okay, Marco, can you talk a bit about the Chowder rule, how to use it, and examples from your portfolio? You've got a video on this or a blog post, and we'll definitely link to that.
Yeah, a blog post about Chowder rule, Marco. But how you look at it is simple. It's a combination of the 5-year dividend growth, let's say average dividend growth, let's say 6-7%, plus the current yield should be around 12. That is considered as kind of a total return ratio. So if you do that, effectively, if you would extrapolate that into the future, that you will have really a good growing dividend at an attractive starting yield. So in other words, it should outperform other stocks if you can extrapolate this in the future. Now, there are some weaknesses to this Chowder rule. Some argue that even if you back test it right now, that it's not anymore, having stocks that outperform in growth. But for me, what I really like about it is like it gives you this combination of growth and current yields. And if you believe that they can continue doing this by looking, for instance, at the payout ratio and the business prospects, I believe that these are companies that can really outperform still in your portfolio. It's really simple as well. So that's why I like it. Upfi for me was always a nice one that scored here really well, but I believe the dividend growth will not be so strong anymore as in the past. Yeah.
Good. Yeah, we'll link to that blog post just to give a more clear picture of that. Next gate, explain your model. This will be the discounted cash flow model for your target price in your stocks final sheet. We give 3 scenarios.
It's really simple. Next gate, it's an average. That's why it's often a little bit not the same. It's the average of the 3. So you can look at the 3 individual depending on your when you look at our videos or our pictures when we share that, and then you see the growth assumption. You can pick one of them, but the other one is the average. So that explains the difference a little bit.
Good. Rafa has asked us about Beatrice. They went under the radar as they did not increase the dividend. They don't really have a dividend growth policy, but he kind of expected a hike. Management was asked on the call about the dividend. There was a bit of a heated response to that. What do you think about it?
I think the company is doing the right things, first of all, because what the company has done, it has sold its biosimilars business at a really, really attractive deal, I would say.
Yeah.
But they are also transforming their portfolio. There's some elevated risk there. Of course, as a dividend growth investor, I wanted to see dividend growth. So that's why I'm where I am a bit disappointed. But, I guess we're used to that as European investors with European stocks. So let Beatrice be another one. But if you look at the current multiples and you think at it as a value investor, I think it's way more attractive for them to reduce the share count right now and position themselves so they can give a nice dividend hike next year. So yeah, I'm kind of with with management on this one. Also, it's an early stage company. Still, they could have given us like even 0.25% a hike here and just bought the difference in back. Yeah.
I mean, I agree with you. They're targeting buybacks and also reducing that debt. That's their priority, and that's what they're saying. I agree with that. Look at their price. Look at their PE ratio. Look at all their valuation multiples. It is really, really competitive compared to any competitors in that market. So it makes complete sense what they're doing. Of course, we would like a dividend increase, but again, I put these in my high yield play. On top of it's probably more a total return play as well. I think there is a lot of upside in terms of total return here, but I'm getting a 5% dividend yield from these at the moment. Yeah. I'm quite happy.
So I was always thinking about below 10. It's really a nice price, but I was looking at them this week, and actually, disclosure, I'm not buying more because they're already kind of around my target size. I could still buy a little bit, but I just every time I'm reminding myself, and it's really hard, I need more high quality. And for me, it is not, Beatrice is not high quality. Yeah, it is a decent business at a really attractive price. It's not I say it, an excellent business at a fair price. And I'm looking more in the second category right now. So that's why I'm not buying more, although it's really difficult for me, but I'm really trying to fight my own inner self in this one, because I really need to change a little bit with my mindset towards this and follow the experience Warren Buffett has, what he reads about when he talks about it. So it's for me really hard to not look at them, but I must. I really must. I really must.
Centrino, again, insurance is quite popular. In the insurance sector, in terms of dividend safety, would you buy NN Group, or I'm assuming he means ASR here?
Yeah, both at 50%. Well, what I did is I bought both 100%. Yeah, so
Nice. Marek has asked us a nice question. What significant change have you made to your investment approach lately?
Yeah, I just mentioned I need to focus a bit more on high quality at this moment in time to bring a bit of strength in my portfolio here from when I did my analysis over the years.
Yeah, mine was similar, and then on top of that, cutting out all the ancillary options, dividend capture, all that kind of stuff. That was my biggest change, and trying to focus more on my portfolio. That's what brought me to Danone. I'm reviewing each one, and yeah, focus on quality is trying to focus on what I perceive as quality is probably more correct.
Yeah.
Steve, thoughts on LOGN? It's a Swiss company.
Yeah, it's Logitech. I really love this company, and I just I looked them up again because I felt like, aren't they heavily overpriced? But I was still remembering them from the COVID spike. I think they went to 120, and they are now back to 40 something. So, and they are now again at around 20 PE and a 2% dividend yield, if I'm correct. So if you want to have a company that is providing products to an industry like the gaming industry, which continues to grow and be the top producer there, if you think about not a niche player, but like a global player, that's Logitech. So I haven't studied the business, Steve, like in depth. I haven't looked at their balance sheet and everything, but how is it? I can definitely understand why people love it, and this might be such a company as a low yield, high growth. But yeah, I just love their business. I love their products. It's all top notch. So yeah, great business.
If it wasn't Swiss, I'd be more interested. That yield is too low to pay 35% tax on that. That's the issue. But Logitech, I have that camera here. I have a keyboard. I have a mouse. I have loads of Logitech.
It could fit in it could fit in a kids portfolio where it's for 30 years or something like that.
Actually, it would be a decent one for a kids one. Manny Mystery, do you think that the high interest rate, inflationary perceived headwind to REITs have been priced in enough to look for bargains?
No, not yet. I think there's still too much liquidity in the market that didn't. Yeah, I think we need to see more storm here.
Okay.
But I'm curious to Manny. Let me know also on Facebook what you think, Manny, if you agree with this thinking.
Yeah, I'm with you on this. I think I don't think we've seen enough blood in that industry, on that sector yet.
Yeah, but Manny is a clever investor, so I'm really curious to his opinion. I value that highly.
Will Ryan, brilliant podcast, lads. I'm taking the highly diversified yet loads of dividend stocks approach. It's just the way my brain works. Have been getting many using Revolut, buying US stocks, but I'm now using eToro for European stocks. There doesn't seem to be very many outside the Noble 30 with a half decent dividend yield. Any websites or suggestions? First suggestion I would give you is get away from eToro.
Yeah, stay with eToro.
You're paying more tax using eToro than you would with a different broker. Just check that out. Don't take our word for it, but check out how much withholding tax you are paying.
I would go to Interactive Brokers if he tells me he was on Revolut and eToro. Yeah. So look, we both have some articles with stocks still on our blog. So it's Noble 30, but I also made some articles about best dividend stocks in, I don't know, France, Germany, Netherlands. So they are more, I would definitely look at them. I think the insurance sector in the Netherlands and Germany is good with Allianz, Munich Re, Nationale Nederlanden, ASR, here as well. Then we have the British one, Legal and General. So just some really good yielding stocks that you could look at. But they don't have a history of 25 years of dividend growth yet. Because, for instance, Nationale Nederlanden as an entity just exists like 6-7 years on its own. But Munich Re is on there. So there are just some sectors that are naturally interesting. The healthcare, think also about Sanofi, Roche, Novartis. There are a few others there as well. So healthcare, insurance, and industrials are typically good sectors. We have Schneider Electric from France as an example as well.
Yeah. There's plenty there. As you said, I've done one on Irish companies. There's a couple of good Irish companies out there. The London Stock Exchange seems to have it's a pretty decent place to look. I think if you're looking at dividend history as well, it often gets overlooked, I feel. But it's still part of Europe. So
and I have also an article on that on my blog, British dividend stocks, and then we look at DCC is an interesting one. CRH you talked about the other day.
Yeah, CRH is there. Smurfit Kappa is there. So there's plenty of opportunities out there. Samuel, what's your take on insurance stocks in current market conditions, both concerning their business idea through insurances, and also their investment strategies?
So I think, it's what you mentioned earlier and what we mentioned last week. They are close to the blast zone, so watch out with that one. Just look at the ones with a good credit rating. That's what I would suggest, and just put them all in a row by credit rating. And the ones with the best credit rating, I think, are probably, if you want to do like a sanity check, right? Look like that. But also on Moody's, you can read their latest reports about the credit rating and just read what they have written in there, under which circumstances they would, for instance, do a downgrade. And after reading that and you feel comfortable, I think you are already more informed than 99% of the other investors buying these insurance stocks. So that's what I would do. Generally speaking, attractive yield at the moment. Just watch out for some of them. They might be yield traps.
Nice. A lot of love for insurers at the moment.
But this is nice. We've seen over the 3 years now here, there's often a certain sector getting beaten up. Now it's the financial sector and mainly around banks, but it pulls others with them down. There were times that the healthcare sector was undervalued. There were times that the energy sector was undervalued. And that's what I love about investing. Sometimes these sectors, they just give opportunities. And every year there's an opportunity somewhere, even if the broader market feels too expensive or something like that.
Nice. It's good words of wisdom to end the show on. Thanks again to all our listeners, all the questions. Much appreciated. Check us out on Twitter, on Facebook. And we will see you all next week.
See you.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.